Hey guys, it is Julie here with TipRanks, and today we're taking a look at 3 strong buy stocks that have recently dipped in price. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 stocks that have declined in price over the last few months, but they still pick up a strong buy consensus from Wall Street Analysts. So today we're going to take a look at these companies, what it is that they do, and what has some downward pressure on the stock lately, plus what those Wall Street Analysts are predicting for the stock's future. Just before we get into all of that, this is your friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's get right into our 3 strong buy stocks. First up, we're taking a look at a company called NICE. They trade under the ticker NICE, currently priced at about $194 per share. Now overall, in the past year, they are up 3%, but recently have cooled off, dropping 20% in the last 3 months. NICE is a software company in the customer experience field. Their product line is designed to remove the friction between companies and customers by allowing enterprise clients to create the seamless experiences that build brand loyalty and create unbreakable customer bonds. Their CX1 cloud-based customer experience platform allows organizations to track and address the expectations of both customers and employees with an innovative end-to-end approach, including purpose-built analytics and AI. NICE did share their latest quarterly results back on May 15th, and they did come out with an earnings beat and saw revenues grow 15% year over year. However, this was a bit overshadowed by their announcement that their CEO would be stepping down after more than 10 years at the helm. They said he would be leaving his position by the end of 2024 and will actively participate in the search for his successor. For their Q1, they did report earnings per share of $2.58, comfortably beating expectations, and that revenue came in at $659.3 million, which was an increase of 15% year over year, and their cloud revenue also grew 27% year over year. Weighing in on the stock following this quarterly report was an analyst from Mizuho Securities. They noted that the company reported solid Q1 results, but the announcement of their CEO stepping down and some weaker organic net new cloud revenue drove shares lower. But they expect an orderly CEO transition with a successor likely announced over the next 6 to 7 months, and believe management's reiteration of its 18% organic cloud growth guidance should provide some relief. We also heard from an analyst at Citi who said that the stock's recent sell-off looks overdone. They said that the company's small earnings and revenue beat was overshadowed by that cloud growth slowing, but after the price decline, it puts their valuation at a compelling 16 times price to earnings. The NICE stock currently has 12 analyst ratings and actually comes in with unanimous buys. And that unanimous strong buy rating comes with an average price target of $287 for an upside potential of 47.5%. Looking at our list of detailed ratings, we have a low-end price target here of $230, which would still be an upside of 18%, a lot of other ratings between that 40 to 60%, and a high-end price target coming in with an upside of 74%. Second on our list today is Genius Sports Limited. They trade under the ticker GENI and are priced at just $5.13 per share. They've had some ups and downs the past year, overall down 2.5%, but have fallen more recently, dropping 25% in the last 3 months. Genius Sports is a tech firm with a focus on sports. They provide iGaming tech services to some of the best-known names and brands in both the betting and sports world, including MLB, NFL, Caesars, and Denver Broncos. They work to reach and activate sports audiences and monetizing that reach through a combination of immersive viewing experiences, marketing services, and data-driven content. Genius Sports provides software services, data management technology, and both machine learning and AI tech to provide a digital connection through a full breadth of the sports ecosystem. The stock has been under pressure this past year as they've had a string of quarterly reports where they had a wider than expected loss, the most recent being their Q1 on May 8th. For their first quarter, Genius Sports reported a loss per share of 11 cents, which was 1 cent wider than anticipated. But the company did have a revenue beat with revenue of $119.72 million and also increased their full year guidance. They also reaffirmed their expectations to generate positive cash flow in 2024. Last month, a 5-star analyst from B. Riley Financial initiated coverage on the Genius Sports stock with a buy. They said that they believe Genius is one of the best ways to play global, visible online sports wagering growth, and that the stock is the firm's top pure-play, real money online gambling stock pick. Following their quarterly report, we also heard from an analyst at Needham. They said that the company's stronger than anticipated results in the first quarter played a significant role in their buy rating, and that they're encouraged by Genius Sports' confident outlook for 2025, where the company expects to achieve double-digit growth and expand its adjusted EBITDA margin. The stock currently has 10 analyst ratings, coming in as a strong buy with 9 buys and 1 hold. And analysts' average price target comes in at $8.63 for an upside potential of 68%. Looking at our ratings here down below, on the low end we do have a hold rating from Goldman Sachs, but still has an upside of 45%. Our high-end price target is from Oppenheimer with an upside potential of 94%. If you've made it to our third stock today, this is your reminder to make sure you hit that thumbs up button. Third on the list, we're taking a look at Caesers Entertainment. They trade under the ticker CZR, currently priced just shy of $34 per share. In the past year, they have fallen 19% overall, but have dropped 18% in just the last 3 months. Caesars is a casino entertainment company, and with more than 50 destinations, they bill themselves as one of the largest gaming companies in the U.S. Their entertainment venues, casinos, and hotels operate under several brand names, including Caesars Palace, Eldorado, Harrah's, Reno, and Circus Circus, among others, and they have locations across over 20 states as well as internationally. Earlier this month, they announced the opening of Harrah's Racing and Casino in Nebraska, marking its entry into the Cornhusker State. Their stock has been battling headwinds this past year as inflation weighs on discretionary spending, and this has been reflected in their quarterly results, the most recent coming out at the end of April. They did have a much wider than expected loss, and revenue declined a few percent year over year. For their Q1, Caesars reported a loss per share of 73 cents, which was much wider than the 8 cents anticipated, and revenue dropped 3.2% year over year, coming in at $2.7 billion. The company did say that moving past the first quarter headwinds, they do remain optimistic towards improved operating results throughout the balance of the year. But with all the recent decline in stock price, some analysts think this makes for a more attractive entry point, including one 5-star analyst from Raymond James. He acknowledges that the earnings release was disappointing, but believes that the investor reaction was overdone, and that after a disappointing first quarter, the shares are now trading at an attractive entry point. They said that there are 2 major investor hangups that have weighed on the stock: digital profitability and higher leverage, and they see a clear path to resolving both issues. Another analyst at B. Riley Financial recently reinstated their coverage on the stock with a buy, saying that the shares are simply undervalued and that the firm does not view Caesars' valuation contraction as permanent and believes any shift could offer acute potential stock upside from current levels. Caesars Entertainment currently has 13 analyst ratings and comes in as a strong buy with 10 buy ratings and 3 holds. And the average price target comes in at $53.73 for an upside potential of 58% from current prices. Looking at our recent ratings down below, our high-end price target does come from B. Riley Financial with an upside of 109%. On the low end, we do have a hold rating with an upside of 10.5%. So that is a quick look at 3 stocks that have been in the red lately, but still come in with a strong buy consensus from analysts. Let me know your thoughts on these 3 companies and which one you think has the best recovery potential. I always love hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, so make sure you're doing your own research and due diligence. Thanks so much for watching. Have a great day, and I'll see you back here next time.